With 2023 right around the corner, it's the perfect time to throw out our predictions for the market. And we'll be starting by looking at some of the key factors and indicators that Wall Street is looking for next year. We'll also be looking at what some of the big banks are estimating the S&P 500 will go at. We'll finish it off by my thoughts, so giving my prediction on what the market has in store. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value, hit that like button. I definitely appreciate that. And with no further ado, let's get straight into the video and take a look at some of the key indicators. The key market decisions that Wall Street is going to be making is based on, first and foremost, the CPI, the inflation. It was a huge topic in 2022. A lot of people think that we have peaked, we are coming down. Analysts such as this one here on this investing.com article say that we could see inflation at 2.5% by the end of 2023. That's coming down from the 7 to 6% that it's currently at, which would be huge for the markets. Why? Because the Federal Reserve would no longer have to increase the Fed funds rates, meaning that interest rates could start coming down. So when interest rates start coming down, the stock market could continue to go higher. And what else are we watching out for? No earnings recession. Earnings are going to be important. A lot of companies have signaled that 2023 could be a down year, but we will see that in the numbers. Sometimes companies like to give low predictions and then smash the earnings, which causes the stock to explode. So we will be watching what these companies' earnings look like, especially if there's a lot of misses in the first quarter. And the third thing is what the Federal Reserve is going to do. I know we touched on it with the inflation factor, but there is going to be a tough navigation still between a hard landing and a soft landing. And we're gonna pull up a chart right now which gives some predictions based on where the Fed and the economy could potentially end up. So this is a chart of the S&P 500. The blue line is what has already happened. The gray line is what analysts are predicting to happen in the future. And there's two expectations here. There's the soft landing, that the Federal Reserve has done a good job by raising the interest rates but not killing the economy too much. On the other hand, the hard landing, the fact that the Federal Reserve is raising interest rates way too fast, way too high, and it's going to make things hurt in the long run. And we can see a hard landing puts us potentially in the 3150 range, whereas a soft landing could put us at 4,000 at the end of the year. So let's take a look now at what some of the big banks and some big analysts are saying when it comes to the expectation of the S&P for 2023. The biggest thing that I picked out when I was looking through these numbers is how big of a disparity there was between the lowest number around the low threes and then all the way up to 5,000 predictions. So we'll be giving you along the way some of what these analysts are saying in terms of what they are predicting for next year. From the bearish S&P forecast, we're going to take a look at UBS, which is predicting a 3,900 number at the end of 2023 for the S&P. And it says history shows that growth and earnings continue to deteriorate into market troughs before financial conditions ease materially. It means that we have some work to do for these higher interest rates to work themselves out of the market. And then after 2023, we could see a bullish run. But for now, it's going to be a choppy year. Next up, we have the neutral forecast for next year. We're going to jump to RBC, which is predicting a 4,100 number at the end of next year. And that's because Fed policy gets closer to a transition and stocks tend to fall before the final cuts, which they're saying we're not done yet. And investors digest on the onset of a challenging economy. There's still more volatility to come because the Fed has indicated that we could potentially see 1 or 2 or 3 more rate hikes, which could hurt us in the long run. Heading into positive territory, we're going to take a look at BMO here, which is predicting 4,300 at the end of the year. And it will be difficult for stocks to finish 2023 much higher than the current and anticipated levels, given the ongoing tug of war between the Fed and the market expectations. The market over the past couple weeks, if not months, has been trying to figure out where the market is lying or where the Fed is going in the future. Are we continuing to raise rates, or are they pivoting? Are we going lower with interest rates? And if they go lower, the market could see this bull run and could head up to the 4,300 number that BMO has predicted. Now we head on to the outlandish. This person must be drunk. Bullish for 2023. We have here Loadout Group. I don't know if I said that, but they're predicting 5,000 on the S&P 500. I think there's very little chance we get up here, but I want to importantly say, after reviewing all of these are predictions. These are our guesstimates. No way and no chance. So these people actually know what the market is going to end up next year. And when it comes to my prediction, my thoughts on the matter is that it is important to stay invested, although things may be volatile. We'll jump over to this article here and read a little bit more on this subject. Volatility is normal, and investors who can stay calm and focus on the long term can ride out the storm. In fact, returns actually tend to improve in the aftermath of big drops in the market. You know, it's so hard to time the market. It's virtually impossible. All these analysts that we just saw, banks, they make the big bucks. They can't even time and outperform the market. So it becomes very difficult for you and I to do so as well. The best thing to do is to buy good companies, stay invested, and continue to dollar cost average. If you happen to time the market and you pull out your money and you miss the biggest day in the market, you're never going to be able to get that return back. It's better to buy and hold. Buy something that you plan on holding for 10 years. That's Warren Buffett, one of the richest men, best investor of all time. That is my thoughts, my prediction. It's volatile, it's choppy. We need to have a long-term vision when it comes to investing. Please stay invested. No rational decisions. Make the decisions that you need to, but obviously make sure that you're doing the right thing. So with that being said, if you're still here with me, I hope you enjoyed the video. Don't forget to hit that subscribe button. We do content like this every single Sunday. So come back, come check it out. I appreciate your support. I hope you all had a great holidays. Enjoy 2023. Best of luck to you, and we'll talk soon.